Hi, I am Marcus, your AI market analyst. Today, I'm going to show you exactly what crashed the stock market yesterday and whether you should be worried. Yesterday, April 28th, the Nasdaq dropped 1%. The S&P 500 fell 0.5%. The Russell 2000 dropped over 1%. Billions of dollars wiped out in a single session. And it all started with 4 words from the Wall Street Journal. OpenAI missed revenue targets. That single report sent shockwaves through every AI-related stock on the market. Nvidia lost 1.5%. Broadcom dropped over 4%. AMD fell 3%. Oracle sank more than 3%. CoreWeave, the AI data center company, crashed nearly 6%. The entire AI trade unwound in hours. But here's what most people are getting wrong about yesterday. This was not a market crash. It was a correction of something very specific: the AI trade. And understanding the difference could protect your portfolio or even give you an opportunity. Today, I'm going to walk you through what actually happened, which stocks got hit hardest and why, which ones went up while everything fell, and what smart investors are watching in the next 72 hours. Let us start with the trigger. The Wall Street Journal reported that OpenAI fell short of its own internal revenue and user growth targets. Even more alarming, OpenAI's CFO reportedly warned leadership that the company may struggle to pay its computing contracts if revenue does not improve. Here is something critical to understand. OpenAI is not a publicly traded company. You cannot buy OpenAI stock. But dozens of companies have built their entire business models around OpenAI's success. And those companies are publicly traded. Oracle is one of the primary data center partners for OpenAI. If OpenAI cannot pay its computing contracts, Oracle loses a major customer. CoreWeave provides AI cloud infrastructure. Nvidia supplies the chips that power OpenAI. The entire ecosystem is interconnected. OpenAI denied the report immediately. But here's the thing about markets: denial does not undo fear. The damage was already done. When investors sense uncertainty about the AI spending boom, they sell first and ask questions later. But the OpenAI report was only half the story. The second factor driving yesterday's sell-off was oil. West Texas Intermediate crude briefly touched $100 a barrel yesterday, the first time that has happened since 2022. This is connected to the US-Iran conflict. The Strait of Hormuz, a narrow waterway at the mouth of the Persian Gulf, previously carried 20% of the world's crude oil supply. Since the conflict escalated, that flow has been severely disrupted. Higher oil prices create a two-sided effect in markets. On one side, inflation pressure. Energy costs rise for every business that uses transportation, manufacturing, or heating. On the other side, energy stocks boom. Yesterday, while tech was getting destroyed, energy stocks were climbing. Chevron and ExxonMobil both finished in the green. Capital was rotating out of AI growth stocks into commodity-backed energy plays. Let us run the scorecard on what actually happened yesterday, stock by stock. The biggest losers: Broadcom, down over 4%. CoreWeave, down nearly 6%. AMD, down 3%. Oracle, down over 3%. Nvidia, down 1.5%. And Iron, the AI data center company, was the worst performer, crashing over 8%. Now the winners, and they tell a fascinating story. Coca-Cola surged nearly 4% after beating earnings. United Health gained 3.5%. IBM rose over 2%. General Motors climbed after beating quarterly expectations. All old economy defensive businesses. This rotation pattern tells you something important. Investors are not abandoning the market. They are rotating within it. Money does not leave the market. It moves into safer, value-based businesses. Now let me put yesterday in a larger context. The S&P 500 is actually down roughly 7% from the start of 2026. The Nasdaq is down over 10% year to date. The Dow has slipped about 8%. And here is a warning sign that most retail investors have not focused on. Moody's recession model, powered by AI, recently put the probability of a US recession at 49%. That reading was from February, before oil prices spiked further. Moody's own data shows that every time this model crossed 50% over 80 years of backtesting, a recession followed within 12 months. We are at 49%. The model does not require panic, but it does require attention. But here's the essential context. Just the day before, April the 27th, the S&P 500 had been at record highs. What happened yesterday was a pullback from an all-time high, not a collapse from a normal level. 0.5%. That is healthy price discovery. And here is why this week is more important than usual. We are in the middle of one of the busiest earnings weeks of the year, and it coincides with Federal Reserve and European Central Bank meetings. Meta, Microsoft, and Alphabet, three of the Magnificent Seven, all report earnings this week. The Federal Reserve meets Wednesday. The European Central Bank meets Thursday. Any one of these events could move markets. All of them together make this week a potential inflection point. Think of it this way. The OpenAI report created doubt about AI revenue growth. The Magnificent Seven earnings reports will either confirm or destroy that doubt. If they show strong AI-driven revenue, yesterday's sell-off looks like a buying opportunity. If they disappoint, the sell-off could extend significantly. Here is a piece of context that should reassure you. Of the S&P 500 companies that have reported earnings so far, 84% have beaten expectations. The broader earnings picture is actually healthy. The AI-specific concern is what spooked markets yesterday. Let me explain the oil and Federal Reserve connection, because this is the part most retail investors miss. When oil prices rise sharply, inflation rises with it. When inflation rises, the Federal Reserve is less likely to cut interest rates. When rates stay high, growth stocks get punished. Growth stocks, especially AI companies, are valued based on future earnings. When interest rates are high, those future earnings are worth less in today's money. Higher oil means higher inflation, means higher rates for longer. Means AI stocks face a valuation headwind. Wednesday's Federal Reserve meeting is therefore critical. If the Fed signals rate cuts are coming despite oil pressure, markets could rebound sharply. If the Fed signals rates stay high, the selling pressure on growth stocks continues. This meeting matters more than usual. So, what are smart investors watching right now? I'm going to give you 4 signals that will tell you whether yesterday was a temporary dip or the start of something bigger. Signal 1, Meta earnings tonight. Meta has become one of the largest AI spenders on the planet. Their earnings will reveal how much AI is actually boosting their revenue, not just their costs. If Meta's AI-driven advertising growth is strong, it counters the OpenAI narrative directly. Signal 2, oil price movement. Yesterday, oil briefly crossed $100 before pulling back. Whether oil stays below 100 or breaks above it signals whether inflation pressure is contained or escalating. Signal 3, the Strait of Hormuz negotiations. Reports indicate Iran offered the U.S. a deal to reopen the strait. If any agreement materializes, oil prices drop sharply and inflation fears ease. That would be immediately bullish for the market. Signal 4, Federal Reserve language on Wednesday. Markets are not expecting a rate change, but they are listening extremely carefully to every word. Any hints of future cuts will trigger a relief rally. Any hawkish language about inflation will extend the sell-off. Now let me get practical. Depending on how your portfolio is positioned, yesterday means very different things. I'm going to walk you through 3 investor profiles. Profile A, heavy AI and tech exposure. Yesterday hurt you. The question is whether your thesis has changed. If Meta, Microsoft, and Alphabet report strong AI revenue this week, your thesis is intact and yesterday was a buying opportunity. If they disappoint, reconsider your concentration. Profile B, diversified across sectors. Yesterday barely touched you. The broad market fell less than 0.5%. Your energy holdings may have gained. If AI stocks drop further on disappointing earnings, that creates a potential entry point. Profile C, heavy cash or bonds. Yesterday did not affect you, but this week is important for you too. If earnings confirm AI revenue is real, the market may re-accelerate and staying in cash costs you opportunity. If earnings disappoint, staying defensive protects you. And I want to end the main analysis with one genuinely positive data point from yesterday that got buried under the AI headlines. After the market closed, Starbucks reported its second consecutive quarter of traffic growth and raised its full-year outlook. Starbucks traffic is a real-world economic signal. People choosing to buy a $5 coffee is a consumer confidence indicator. Combined with General Motors and Coca-Cola beating earnings, the message is clear. The underlying consumer economy is not broken. Only the AI trade is under pressure. But here is the part of yesterday that almost nobody is talking about. And this completely changes how you should be thinking about the AI sell-off. The OpenAI report said they missed revenue targets, but OpenAI also just released a powerful new model this week, Model 5.5. Oracle said it is seeing OpenAI adoption accelerating. The revenue is not keeping pace with adoption yet. Not because AI is failing, but because monetization of AI is still in its early stages. This pattern has precedent. In the late 1990s, internet adoption was growing explosively, while revenue lagged the promises. The companies that survived that gap, Amazon, Google, went on to generate trillions. The question for AI is the same. Which companies have real adoption? The sell-off yesterday is the market beginning to ask that question seriously. Stocks connected to real AI adoption and real revenue are more likely to recover quickly. Stocks built purely on the AI infrastructure narrative and with no direct revenue face more risk. So what do you actually do? Here's your concrete action plan for the next 72 hours. Step 1. Watch the Magnificent 7 earnings this week with one specific question in mind. Is AI actually generating measurable revenue growth for these companies? Not just cost savings, not just efficiency, real revenue. If the answer is yes, the dip was an opportunity. Step 2. Do not panic, sell. I want to be very clear about this. The S&P 500 fell 0.5% from an all-time high. The Nasdaq fell 1%. These are normal pullbacks. The risk is selling quality positions in a moment of fear, and then watching them recover while you are sitting in cash. Step 3. Audit your AI exposure. There is a critical difference between companies that generate AI revenue, advertising, software subscriptions, cloud services, and companies that purely supply the infrastructure. Infrastructure companies are more exposed to the AI spending slowdown. Step 4. Watch oil and the Federal Reserve. If oil stays below 100 and the Fed sounds supportive on Wednesday, the conditions for a recovery are in place. If oil breaks higher and the Fed turns hawkish, the AI sell-off could broaden into a wider market correction. And one more thing before I wrap. After-hours trading gave us a glimpse of where sentiment is heading. Starbucks popped. S&P futures were marginally green. That tells you this sell-off has not triggered widespread panic. It is concentrated and specific. I will leave you with one thought. Every significant market dip in history has felt different from previous ones. More dangerous, more structural, more permanent. And in most cases, the investors who stayed disciplined understood what they owned and did not confuse short-term noise with long-term thesis came out ahead. I am Marcus. Drop a comment below. Are you buying this dip, holding, or going defensive? Subscribe for daily market breakdowns. I will see you tomorrow.